Okay, so now we're going to talk about the other part of chapter 5 that deals with inventory. And we are now going to migrate from the purchasing side to the selling side. So hopefully at this level you understand that there is a difference. And one of the main concerns that I have for you guys is that you know exactly how to account for each part of the transaction, whether you're being a purchaser or whether you're being a seller of inventory. And so to recap what we're talking about, remember, inventory once purchased is an asset. The minute that it becomes sold, an expense is created called cost of goods sold. So now we're going to talk about how to identify working as a seller of inventory. Okay? And so we're going to start off obviously with sales. And so let's go with the days. I'm going to try to remember what was the last description that we did for our examples and kind of use the same stuff, okay? So let's say it's May 1st, and let's say that we're going to handle a sale, okay? And so let's say suppose that we sold inventory costing fix this for you guys. Suppose that we sold inventory costing let's say $5,000 on account 210 net 30 for $10,000. All right, so suppose that we sold inventory costing $5,000 on account 210 net 30 for $10,000. Now, a couple of keywords we need to identify: sold, inventory, I guess on account, right? And so a couple other things you want to take a consideration into is that we have two numbers. And we have two numbers for a reason. Why do we have two numbers for a reason? Think about it logically. In order to sell inventory, you have to first what? Buy inventory. So we buy inventory at a price, and of course we always sell inventory at a price above what we purchase it for, right? So one of these prices represents the selling price, the other one represents the cost to the seller, whom is us, right? And so we're going to have a journal entry for this sale, but we're going to have two separate journal entries, okay? One to identify one cost, the selling price, and the other one to identify the actual cost that the purchaser had to pay for, who was actually us. So anytime you have a sale, you need to understand the fact that you're going to always have two journal entries. One to account for revenue, for what you sold at the selling price, and the other to account for the inventory that you bought, cost of goods sold, the cost of your goods sold. So let's account for the revenue. Now, of these two numbers, which one are we going to use for the revenue? The smaller number or the bigger number? Obviously, we're going to account for the bigger number because we always sell at a price above what we paid for it. This being the highest number, this is the revenue number. So, how are we going to account for it? It was on the account. So we're going to debit accounts receivable. And we're going to always credit sales revenue. Now that's going to be for the $10,000, the big number. We're not finished because we have to also account for the $5,000. Remember the key fact. Whenever you sell inventory, an expense is created and it becomes cost of goods sold. So what happens is that what you have to do is you have to take inventory off the books and turn it into cost of goods sold, the actual expense that's created. So to increase an expense, we always debit it. So obviously we're going to debit cost of goods sold. Think of the keywords in that description. Cost of the goods sold. What's the cost? See, cost $5,000 And we're going to credit what? Inventory. Taking inventory off the books for $5,000. And so anytime you have a sale, your transaction should go like this. The next thing that I'm going to identify will be a sales return. No, how about a collection on account, right? A collection on account. Again, another thing we need to note is that we do have discount terms here. 210 net 30 is May 1st. So basically we're giving a discount to our customers if they pay within what? 10 days, they get 2% off. So let's see if we can collect something within the 10 days. So now we're going to talk about May 4th. And let's say we're going to handle a collection within discount. So how are we going to do that? Basically, what's happening when we collect on an account? What's going on when you normally collect on an account? Your cash increases and your accounts receivable goes down. So let's record that. We're going to debit cash and we're going to credit accounts receivable because we collected on an account. Now, the same rule will apply for collecting with a discount or without a discount. Your account will always be the full amount. Always the full amount. So let's assume that I forgot to give a description in this, right? So let's suppose that we collect $4,000. Let's suppose that we collect $4,000 on account. So again, collection on account, we're going to debit cash, and we're going to credit accounts receivable. Okay. Now, our accounts receivable, as I mentioned, is going to be the full amount. The full amount being $4,000. But what about our cash? How much cash are we going to receive? Are we going to really receive the $4,000 cash? Absolutely not. Why? Because it is within the discount term, it being May 4th, and the discount is extended up to 10 days after the 1st of May. So we're going to not receive $4,000, we're going to receive $4,000 minus 2%. And we calculated this last time. That's what? $40, $80. So that'll give us $3,920. Our debits and our credits don't equal right now, so we still have an incomplete transaction. What's going to happen? Think about this logically, okay? We first sold a product to somebody and we agreed that if they pay within a certain time frame, that they will be able to receive a discount, right? So ultimately, that discount that we extended to them will affect how much we actually generated the sales in. Sales being revenue, right? Sales being revenue, we knock some off of the price that we charged them, right? So ultimately, these guys are actually saving $80 for the cost of the inventory on their end. But on our end, we're losing $80 in what? Sales revenue. So what will we logically affect? And the correct answer would be sales revenue. It is. But the journal entry is different. We're going to debit an account called sales discount. Sales discount for the difference, the $80. Now, I thought you just said, Dr. Holloman, that we are supposed to affect revenue. We are. We're doing it through this account. Sales discount is a contra account to sales revenue. Very important. I'll say it again. Sales discount is a contra account to sales revenue. And so it's going to do what to sales revenue? Naturally, it should decrease sales revenue. Now, sales revenue belongs on which financial statement? The income statement. So where should sales discount belong? It should belong right under sales revenue. And it's going to do what to sales revenue? Decrease it. So you should subtract it. Okay? Let's move on. Let's say that now it is the 5th May 5th, and we're going to handle a sales return. So this time, we sold a product and we are receiving the product back from the customer. Suppose that we received a return of inventory for $1,000 costing $500. So on the 5th, let's suppose that we are receiving a return of inventory for $1,000 costing $500. What are the key words? A return. We received a return, right? And of course the $1,000 in the costing. So think about this logically. What is going on with this? We sold to a customer, and now the customer came back and actually brought back the item. A couple of things should happen to us from the business standpoint, right? Our sales revenue should decrease because we no longer sold a product. Our accounts receivable should also decrease because, again, we no longer sold a product. But what about inventory? Is something going to happen to inventory? Shouldn't it? Yeah, why? Because we physically have inventory now. And so inventory needs to do what? Go back on the books. So notice we have two numbers. We have two numbers for a reason. Because we have two journal entries once again, just like the sale. See, on the selling side, you have more stuff to consider. We have to handle the revenue portion of this sales return as well as the inventory portion. So what's going to happen? We already know revenue is going down. But we don't like to touch revenue, as you can probably see. We don't like to touch revenue. Once we credit revenue, we never like to decrease it. So we use other accounts. So we have an account that we're going to debit called sales returns in allowances. Very long account that we're going to debit. And we're going to credit accounts receivable, lowering our accounts receivable. So right now we've just lowered revenue and accounts receivable. Now, which number are we going to use? Of course, the big number. Sales is always equatable to the big number. Are we finished? No. We have to put inventory back on the books. So how are we going to put inventory back on the books? We're going to reverse the sales transaction. Remember, initially we debited cost of goods sold, credited inventory. Now we're going to debit what? Inventory. And credit what? Cost of goods sold. Very good. Big number, small number? Small number. How do you know? Cost of the goods sold. It cost us $500. And so that's how you would handle a sales return.